All right, ladies and gentlemen, welcome to the US CPI report with your host, Tony from MACROACE, and also the head financial analyst at FinancialJuice. We have quite a bit to go through, as always. There's also a lot of sentiment to kind of weed our way through and kind of understand how the markets might react to the CPI data. But first, we've got to understand what the CPI release is all about, how it affects the markets, and what are the deviations from the past releases that we've seen with the CPI report. So first of all, we understand that it shows you how much consumers are paying for retail goods and services, and the way it's measured is that you have 26,000 retail outlets and 4,000 housing units in 87 urban areas where prices collected on 80,000 different goods and services. So the key measurements that make up the CPI report itself. First of all is housing, about 42%, food and beverages, 14%, transportation, 18%, and medical care, about 8.5%. Then, of course, you have the core data, which excludes food and energy. Of course, that had been quite volatile. Now the shift has kind of gone towards the services side of the inflation report that we're going to get today. And whether or not that still holds up, or how strong that is, or whether there is, if we do start to see a decline in that area. But again, that's what the CPI report is all about. So remember, usually within a normal market environment where the Federal Reserve isn't doing anything with their rate hiking cycle or cutting cycle, the CZ adjusted or the month-to-month figure is usually the one that's preferred to show what's going on within the economy. Of course, that strips out the effects of weather, the production cycles, but we know at the moment that the year-on-year data, or where is inflation, where is the headline data at the moment, that's what the Federal Reserve is focused on. Okay, they are focused on the other reports as well of the inflation report, but the year-on-year data has been the one that everyone is kind of keeping a focus on. But it doesn't mean you can put the other ones to the side and forget about them. Don't forget, if you find this information useful so far, don't forget to share it with your fellow friends and traders, get the word out there as well. Then the difference between PC price index and the CPI price index. Okay, so the PC price index, or the personal consumption expenditure, first of all, it's a preferred measure of the Federal Reserve for inflation, and it places a lower weight on the prices of gasoline and residential rents, and focuses on the nation as a whole rather than just focusing on urban areas. So the CPI price index, or the CPI, what it does is, as I said, it focuses on the urban areas. Hello, Andy Bleed, good to see you. Good to see you joined the stream. But yes, so the CPI report focuses on the urban areas where most of the money is spent, compared to the PC price index, which looks at the nation as a whole. The other part of the PC price index is it doesn't measure a fixed basket of goods. It can kind of chop and change what it looks at, compared to the CPI report, which does measure a fixed basket of goods for about a couple of years or so, and is more or less restricted to what it can measure. Then if we carry on, so how does it affect the markets? So CPI, we've seen that when the CPI data is much stronger than expected, the dollar tends to strengthen. In a normal market environment, that shows that the economy is doing well, but depending on how far inflation goes, then it could become hyperinflation. If you want to become like Venezuela, or if you want to become like Turkey at the moment with hyperinflation. But so in this market environment where the Federal Reserve is hiking interest rates and tightening monetary policy, then you usually see the expectation for the Fed rate hikes start to increase as well, and the dollar sees more of an appreciation. Okay, so of course, with a high rate of interest, you have foreign traders, foreign investors who will jump into the dollar to use the dollar compared to other currencies, and also to get a higher rate of interest in return as well compared to another nation. So that's what happens to the dollar if you do get a CPI data that is much higher than expected. Stocks, underlying inflation, particularly the core data, is very important, but we know that overall the inflation report is going to be important itself. But if you do see inflation that is much higher than expected, the stock market isn't going to take that in great stride. It could lead to it taking a hit instead. the expectation the Federal Reserve is going to raise rates. If we do see the flip side where inflation does come down or is lower than expected overall, or there aren't any big surprises or big jumps in inflation in the report, that can lead to the stock market seeing a bit of a reprieve or seeing a boost instead, in the anticipation that the Federal Reserve has done their job or is doing their job with bringing down inflation. So that means that the terminal rate doesn't need to be that high compared to what markets might be expecting. Okay, so that's another thing just to be aware of there. That's the flip side of the coin. Now with the bond market, we've seen how the bond market has been reacting, with traders flocking to bonds in recent days in fear of SVB and what's been going on there as well, and how that's also had a wider effect on the market, trading markets as a whole. But we've got to understand that the bond market, when you do get a higher rate of inflation, that again, it's the same thing with the dollar. The yield goes up in anticipation of higher rate of interest from the central bank. But in a normal market environment, if you do get better data, or let's say the economy is shown to be growing and prices are rising in a healthy way, again, yields can also rise in anticipation or in the expectation that the economy is doing well, it's strong enough to kind of handle high rates of inflation, and people and spending has also picked up. Okay, that, again, that's also another sign too of a healthy economy. But on the flip side, for the bond prices, if you've got it's very simple. If yields are higher, bond prices are lower. Then if we go on to the previous report from what we'd seen, so the month-to-month data, what we'd seen, the index for shelter was by far the largest contributor to monthly all items increase, accounted for nearly half of the monthly all items increase, with the indexes for food and gasoline and natural gas also contributing as well. So yeah, for the month-to-month data, again, the key point is that you have prices are rising in that area again, but not by as much as what we've seen in the past. It's more or less moderated from what we've seen with the month-to-month data. So could that mean that we get moderated data, more moderated data for the month-to-month today? Well, again, that's got to wait and see what happens. But this is how the data. If we're looking at the table, I want to show you one key point is the services side of inflation, which has been cited by the Federal Reserve and also people within the government, that the services side of inflation is something to be aware of and keep an eye on. That has increased from 7%, and is now at 7.2%. Again, something that the Federal Reserve is worried about. If services inflation does continue to tick higher, then they might have to do more to contain inflation or rein it in with raising rates for a little bit longer than they probably want to. So that's one thing to just bear in mind, is that is still a sticking point for the inflation report. If services, remember in the past, it was energy prices that rocked the inflation reports. Now the energy prices have come down and have taken less of a prominent position within the inflation report compared to services. That's something that, again, the narrative switches from one sector to another sector or another part of the inflation report. So again, sticky inflation, that could still occur. There is the possibility of that happening. Then, as said, we had services rose by 7.2% year-on-year, excluding energy, compared to 7% in the December report. So this is how, but overall, the picture for inflation, okay, we can see maybe a couple of reports of how inflation has been, in the last couple of reports, but an overall picture of how inflation has come down and why the Federal Reserve have been acting in a less hawkish way. We've seen them go with a 25 at the last meeting, with going to 4.75%. But if this is the picture that they're seeing with the CPI data, that there is a first of all, you see this gradual slowdown in inflation. The only problem is does that start to hop about, and does it start to go back up again and then go down, or do we see a continuation of this clean path of inflation heading downwards? So that's the worry that again, even though the overall picture shows that inflation is coming down, the Fed's job is working. The worry is does that narrative change, and does the data actually start to surprise back towards the upside, and do we get sticky inflation? So where is the economy at the moment? So non-farm payrolls, which we had last week, were 311k versus the prior 517k. So moderation, not as much of a moderation as what economists were looking at, around the 200k mark, but still lower than the prior figure. The unemployment rate ticked up to 3.6% compared to 3.4%. 3.4% was at a 50. We were in the US at a 53-year low with the unemployment rate, and we just went back up. Average earnings was up as well, at 4.6% versus 4.4%. Employment cost 1% versus 1.2%. PC price index of 5.4%. Versus the prior 5%. Core PC price index of 4.7 versus the prior 4.4. ISM manufacturing prices paid 51.3 versus 44.5. Services prices paid at 65.6 versus 67.8. And then productivity 1.7% versus 3%. Import prices was at minus 0.2% compared to the prior 0.4%. Export prices spot 8% versus minus 2.6%. PPI, which don't forget tomorrow we have that data coming out tomorrow. I'll put the link for you guys to watch that for tomorrow. Don't forget again, if you like this video so far, don't forget to subscribe to the channel, get the word out there, share the video with fellow traders and friends. All right. So if we carry on then, so what are the triggers then for the economic release? And we'll look at the deviations at the same time as well. So for the month-to-month, the high estimate, according to what economists are looking at, is at spot 5% with a low of spot 2%. Of course, remember the median estimate for the month-to-month data is spot 4%. So you're not really, if you do see data surprising towards the upside, there isn't really that much room for it to recur. With the year-on-year data, high estimate of 6.3% with a low of 5.8%. So again, median estimate is for inflation to tick down to 6% from 6.4%. So looking at 0.3 deviation there, and a 0.2 deviation on the low end for the year-on-year. Core month-to-month at spot 5% with a low of spot 3%. Remember the median estimate of spot 4%. So similarly to the month-to-month data, not really leaving too much room. Core year-on-year, high estimate of what economists see at 5.6% with a low of 5.3%. So all in all, the picture, the way you got to take this, what we're seeing here is that the deviations, economists aren't leaving much room for a big divergence to occur. What does that mean? Well, one thing it can mean is that inflation is going to be sticky compared to what it has been in the past, and that doesn't really allow economists to bake in maybe a higher rate of inflation compared to what they've been able to do in the past. So that's one thing to consider, is that things are a little bit tighter. Inflation is going to probably take a little bit longer to get inflation to go down towards the 2% target. So that means that the surprises for the report could be, if we do get, an overall report that shows inflation is higher than expected, but not too much of a deviation, that could lead to the markets taking one direction, if it wants to. So sentiment and views. Okay, so this is the big dog. Christopher Mundell says, "Thank you for doing this. No worries. Thank you for joining. Sentiment and views. SVB turmoil. This has been a very interesting past week. So since I came back from my holiday, it's like the banking system was waiting for me to come back from my holiday, and then it starts to crash and implode, and the markets just decide to just die. So SVB on the weekend, and well, actually last week, when they had their issues of with dealing with the tech industry and not really being able to kind of pay off whatever they had, or being taken over. Basically, first of all, the UK branch has been taken over. The US branch, meh. There's still kind of been, you can more or less say it's been taken over by the Fed and the government. But the SVB turmoil, what happened is that the markets were starting to switch their mood or switch their tone a lot in this past week. Is that you had markets were expecting that the Fed, Fed pricing goes to no change. They're expecting for next week's meeting that there would be, or should be the meeting coming up, that there would be no change to the rate. The rate will stay at 4.75%. Goldman Sachs. So going back to SVB, again, we'll go through the market pricing for how it's changed with the Federal Reserve and what they're expected to do. Not so much inflation. The focus is on how the banking system is going to hold up, or is it, or has it already kind of crashed and crumbled? But we're just getting news of other banks that are coming out. Credit Suisse this morning said that they found material weakness in financial reporting, but they had no material risk from SVB itself. So that's one thing to bear in mind, is that the markets, yes, they're focused on the CPI data. That's important before the Federal Reserve. And the only problem is that the banking system and how the government deals with it, or the domino effect that's created by one bank going down and then all the other banks start to go down. Okay, that's something to be aware of, is that you could have the reaction from the CPI report, but then the markets will go back to focusing on how the banking crisis or the potential banking crisis turns out, and if they continue to head, if we do see choppier reactions within the markets, where there's no real clear direction, or there is one clear direction and the markets continue to head down if the banking crisis becomes worse than what we've seen recently so far. So that's one thing to bear in mind, is that because of the turmoil, traders believe that the Fed might switch their tune and actually start to try and go towards supporting the economy instead. So Goldman Sachs, way before this ever happened, so Goldman Sachs CEO Solomon said general consensus is that inflation will be stickier, and we've seen that when I showed you in the past with the expectations of the high and low end of each of the inflation reports. March 12th was from BMO, so you had them saying that, Yung Ma saying that there's heightened sensitivity among investors to the CPI data, especially given what's happening in the banking sector, and concerns that the Fed interest rate cycle is starting to have a rippling effect throughout the economy, and this is somewhat of a fragile time for equities. And it's very, very, very obvious that we're in that situation at the moment. So again, yes, CPI is important, but what's going on in the banking system? Are we gonna? How quickly will we see the domino effect occur, or will it take a while, or will there ever be a domino effect in other banks? Maybe this is just contained with a couple of the smaller banks, but in reality, if we're looking back to past events, to 2008, past events say that that containment doesn't really happen that well, and actually things just start to get worse, and then Boom. There you go. That's your economy gone again within a space of 2 years since the COVID crisis that we had. But again, just something to be aware of from what some of the sentiment is, and that's a recent sentiment as well. So Fed and government, Bullard said markets anticipate that inflation will be brought under control in the coming quarters and years. Powell says if the totality of incoming data indicates that faster tightening is required, we are prepared to accelerate rate hikes. The ultimate level of interest rates is likely to be higher than previously predicted, but we'll see what Powell says at the upcoming meeting and what they decide to do at the upcoming meeting, whether they do decide to go with another rate hike or if they decide to hold rates instead. March 8th, Fed Beige Book, wages have generally increased at a moderate rate, which is expected to slow further in the coming year. Now, market pricing. This has been the volatile part, and we'll get to the last. We're near enough to look at the deviations as well. So, February 14th, Fed swaps no longer price in 2023 25 base point rate cut. And they started pricing in the highest policy rate in July 2023 of 5.27%. 22nd of Feb, Fed swaps upgrade bets on a 25 base point June hike to near certainty. 24th, their policy seeing a peak policy of 5.4% in July 2023. March 1st, 5.49%, September 2023. Then, Powell speaks at his semi-annual hearing, and he spooks the markets and says that more or less says that more work needs to be done, and that the Federal Reserve will be willing to do that if necessary with interest rates. So a peak policy rate had climbed to 5.61% by September. Okay, and Fed swaps were repricing or looking at a 50 base point hike in March over a 25. So things were getting worse for the stock market. March 8th, again, Fed swaps upgraded the possibility of a 50 base point hike to 75%. Then recently, what we've had since the SVB debacle, and this is the latest point here. So Fed swaps price a peak policy in May. Right, so much sooner than September or July, and then they see 75 base point of cuts by the year end. The most recent Fed OIS pricing shows a peak policy rate of around 4.83%. This is yesterday. Okay, from the from the fallout from the SVB or the banking crisis that we're starting to see for the May meeting. So they will see approximately 25 base point of additional hikes from the current Fed rate, then around 325 base point rate cuts from May into December meeting this year. So what have we seen in the past with the Federal Reserve? Back in 2008, when the banking crisis hit really hard, when things broke, then the Federal Reserve stepped in and started slashing and cutting interest rates. So the fallout, yes, there is a big potential for it to get worse and the domino effect to roll on. But this is one thing, is that's what's currently taking hold of the markets, is first of all, trying to price in what the Fed might do for the upcoming meeting. And then how bad does the banking crisis get? Do we start to see even worse reaction within the markets, or was the government able to kind of contain the issue as best as they can? In the past, we've seen that's never happened. They just printed the money instead and said, "Hey, here you go, hush hush," instead. But that's the most recent market pricing that we've had as well. Now, investment bank estimates, I think we'll kind of skip this bit here. But more or less, you're not seeing too much of a deviation from the current estimates for the data. But you can see Goldman Sachs, JP Morgan, Bank of America providing, again, as I said, not too much of a deviation from the current median estimates of the forecast figures. Then if we look at the deviations for the economic release, this is what I want to show you. Is very important. CPI. So here we've seen that when data, see, even here with you see a point, at least a 0.2 deviation, or if you see inflation higher in one area compared to another, right, whether it be the month-to-month, year-on-year, or core year-on-year, month-to-month, that the markets will take that in stride, and or take that as a negative or positive step, and this is how the markets will react. So when we've seen that data has been, if data is higher than expected, we've seen that the stock market has taken a hit. Doesn't really bode well for the stock market. We've seen on the NQ 486 ticks down on the initial market reaction, going to the wick of the candle on a 1 minute chart. Okay, and then here this shows you the reaction 10 minutes after the release. How many ticks has the NQ created 10 minutes after the release, going to the end of that candle. Again, all of the 1 minute on the 1 minute chart. But you can see here that, again, if data is higher than expected, then you see a negative reaction or a bearish reaction from the stock market. If we're looking at the currency pair wise, what's had the biggest market reaction? So even here, right, this is I should say so you can see here the biggest market reaction that we had seen is from the dollar yen. Apologies if it said down, I should say up. So the biggest market reaction in the past has been the dollar yen to the data. Only a couple of times would you've seen the dollar CAD maybe see a bit of a stronger reaction compared to what we've seen in the past. But overall, dollar yen has seen the biggest market reaction. So again, positive data would could bring about the dollar yen seeing another strong reaction compared to its other counterparts. But if we're looking at it at a list or hierarchy, then it goes cable, and then you have dollar CAD, and then the euro dollar that has the strongest reaction. Or we have the exotic. We have Aussie dollar and New Zealand dollar. Then if we're looking at the bond price area, we've got about 2 minutes, by the way, or less than 2 minutes. Bond prices 44 ticks down on the 2 year. Again, that's rate sensitive part of the yield curve, and reacts the most to interest rate hikes or cuts or monetary policy. So that again had the biggest market reaction compared to the 30-year and also the 10-year as well. So stocks prefer lower than expected data. If it's more or less in line with expectation, you're going to get this sort of reaction where it's mixed. Okay, you might get an initial positive reaction or a negative reaction, and then it reverses the other way. So a whipsaw reaction. So you want to see a clear direction in the data going either up or down. We've got a minute left, but up or down is what you want to see, or clear direction for the markets to get that volatility that we've seen in the past, the markets moving in one direction. Okay, so we don't have time to go watch this. So we're going to have to look at the markets. Get this here. Dollar yen, S&P. All right. Okay, getting close to our timer here. All right, 10 seconds left. So remember, there could be the reaction that happens, and then the markets go back to Okay, 6%, 6% as expected. CPI month on month, spot 4%, spot 4% as expected. Core CPI month on month, excuse me, core CPI year on year, 5.5%, 5.5% as expected. Core month on month, 0.5%, 0.5% higher than the forecast of 0.4%. So this is how the markets are reacting. The data was more or less in line with expectation. Okay. And then, I'm just going to bring that up here too. The data was in line with expectations, and barring the core month and month, which had seen the initial movement down in the S&P 500 and initial strengthening of the dollar. But the overall picture, what we've seen last time round, is that the markets might instead, well, actually, as said, it could either start seeing more of a whipsaw reaction, which it did. So we're seeing some movement towards the upside there on the S&P. Well, it's trying to move up. Let's have a look. What else have we got here? The data was as expected. Gold. Bond prices. Okay. Ooh, let's do some measurements. So what I want to do is kind of capture what the initial move was here, and then I want to and then I'll get the rest. Okay, so there's 147 or 149 ticks down. And then if we're going from here again, where did it end up? Or to the wick of that candle? Well, this candle was at 49 ticks towards the upside instead. So again, there isn't one clear direction. And as you can see, you're not seeing the market's really taking off in one place. Yeah, so the only hot data was month to month. Cool. Was the only hot bit. Let's kind of go here. Let's kind of see what we got. So we want to go from, right, see what we got. So the initial was about 44.5 pips. See what we got. So US short-term rate futures add to prior losses after inflation report. So this now it depends what traders are going to do. Whether they're going to price in no rate hike from the Federal Reserve, or they're going to price in a 25 base point hike, is what we're yet to see. Right, bond prices. We'll get to gold as well, see how that reacted. So all right. Oops. 49 there, and then go 70 down. Okay. So again, a whipsaw reaction from the markets. Now, don't forget if you like the video so far, if you found it useful, don't forget to like the video, share it with your fellow traders and friends, get the word out there, subscribe to the channel. There's 84. Okay. And then what did it try and end up? Went here. I'm 33 up. Okay. But yeah, so don't forget, FinancialJuice is where we get the live data from for the economic release, all in one place. So if you're unfamiliar with what FinancialJuice is, FinancialJuice, what it is, a live voice and text service where you can understand why the markets are moving in a certain direction, what's going on in the markets, what are the needs to know, what is the risk to be aware of for the trading day ahead, what's already happened. That's all in one place. Remember, a live voice and text service is something that the big boys at the investment banks have access to, or readily available to them. Compared to retail traders, they don't really have access to a live voice and text service. They might not have heard about it. It might be something that's not readily available to them. But again, a live voice and text service is something that everyone needs to understand why the markets are moving in a certain direction. And we've seen with the SVB news and the banking news that's caused a lot of the sell-off and the volatility within the markets. If you're just looking at the charts or looking at technicals, okay, great, if that works for you. But having the voice news there as well to kind of maybe to confirm what your ideas might be, or to help you manage your risk that you have, or manage a trade, or jump on a potential trade, then that's what a live voice and text news service is there for you to use for. Again, you use it however you want to use it. If you've never used a live voice or text service in the past, kind of get used to it. And that's why you can, of course, sign up to FinancialJuice. There's the live version of FinancialJuice, which is completely free, but there is a delay to the website. You do get adverts, and you do get advert banners that appear on the site. But in order to, if you want to kind of, if you want to go to, if you want to go pro, that's completely down to you. If you feel comfortable with working the website, if you want to go pro, then there's a button that kind of appears here, which says go pro. And then you can sign up to make sure you have a FinancialJuice account. If you don't have a FinancialJuice account, then it makes it harder to kind of make sure that you do get pro. Get a FinancialJuice account first with your login details. Then verify your email or your account in your emails. Come back to the site, go to pro, choose whatever subscription you want to choose. Then what you need to do is just log out and then log back into the FinancialJuice site, and then you should see the page like this. Of course, you can change the color to if you want to swap it around, but if you see this logo saying FinancialJuice Pro, then you are pro. We had a lot of comments. Dragon says cheers and bye. Tarsem says thank you, team. MB Traders said he believes in a crash in Bitcoin, but after the collapse of SVB, Bitcoin shows high stability. Well, I'm not sure about that. I think it's just, so here's how I take it. Okay, with this SVB debacle, and whether you agree with me or not, but compared to 2008, you've seen The Big Short. If you've seen how there is the domino effect that is created from one bank taking a hit, the Lehman Brothers, right? They take a hit, bam, everyone else starts taking hits because everyone's interconnected with each other. So if somebody takes a hit, then it's going to affect everyone else. So with SVB, if that situation gets worse, and there are spillover effects into other areas of the banking system, then the market reactions are going to become bigger, and it could then become one big ugly mess for the Federal Reserve and the US government to try and deal with. But then not just the US government, but then also in other areas too, in other countries that are going to have to deal with the fallout that comes through with these seemingly small banks that don't have, they're not the Goldman Sachs or the JP Morgans of the world, but those issues have had an impact on the markets and the perception. So if the other big boys start to take hits and they start having issues or revealing that they have material issues, then it's not going to be a nice mess. And then the idea of your risky assets goes out the window and everyone jumps onto safe haven assets. That's my take on that. Personal view, not an official view. So do take however you want to take it. So that's Financial Juice Pro. Now TickStrike again. So TickStrike, if we're looking at it here, so TickStrike allows you to listen and look at how much of a buying or selling momentum that there is within the market. Okay. Oops. And what that, so as we can see here, so you can look at that buying or selling momentum within Forex, crypto, stocks, ETFs and ETNs, and also your internals like your VIX. So what is this little box here? Okay, so this little box here is the ticker, and it shows you the buying or selling momentum and how strong that is in this box here. Now, what is the plus symbol shows the buying momentum, and then the minus number shows you the selling. So what is this number here? What is this 1? What does that got to do? What is this little slider thing? So this slider allows you to adjust the level of sensitivity of the ticker. So 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that kind of goes on, TickStrike will go up, as you can see here with the dollar yen, and also in the stock indexes here. If you want to, only want to see where there's a lot of buying or selling momentum, why more volatility, then you can increase that level all the way to level 15. Okay, you can kind of drag and change up whichever level suits you, all the way to level 15, which is the least sensitive to market reactions. And again, only when there's a big amount of buying or selling momentum going off will then compared to that time, and if it meets the requirements of TickStrike for that ticker, then only then will it go off. So that's what TickStrike is. There is a 7-day free trial of TickStrike as well that we want to share with you guys. Again, it's also on the website, but in a very limited way. So you have the S&P, Euro, Dollar, Oil, and Bitcoin. You can only select one of those. Constantly kind of keep it open like this, and you're more or less limited on the free version here, and it's at a set level. But yeah, so that's TickStrike there. And don't forget, so if you like trading high probability stocks, futures, Forex, and crypto breakouts in real time, then you can join Unusual Activity and also have a play with that as well, and see how that works for you. Okay. And then finally, deviations for the economic release. That's also free. But but your question is, well, Tony, how do I get access to that? Well, the way you can get access to that is, Taylor Adams says, your site is a bomb, bro. My go-to. Thank you, Taylor. Thank you very much. But yeah, so if you want access to the deviations for the economic releases, as I said, that's completely free. Then you can sign up to the mailing list. I send one email every Sunday. Bearing in mind that when I came back from holiday, I didn't send one out on a Sunday because I just came back and I was tired, man. That jet lag hit hard, right? That was like a brick wall. But so every Sunday, one email is sent out to our subscribers of what to expect for the US, European session, and Asia, the deviations for the upcoming economic releases, and also the summary of the weekend news, okay, of what had happened. Of course, Sunday is when the SVB stuff kicked off at the beginning of the Asia session. But there's some stuff before that anyway, of the government wanting to make an announcement. It's not a big old thing. It doesn't have charts or graphs in there. It's just a short summary of what to kind of expect from what to kind of expect from the week ahead. And the honey comes here when I explain it to you guys in person, like this, in a live stream. Let me get that basically concludes the stream. As I said, don't forget to share the video, subscribe to the channel, get the word out there. I'm going to find the link to the video for tomorrow, for PPI. I have a feeling that if the CPI report has reacted like this, and there isn't too much of a deviation, there might not be a lot of reaction from tomorrow, but I hold my tongue. Could be the opposite. Could have a could be the opposite. It might have a nice big old reaction. All right, that is the live stream for the PPI report for tomorrow. Ladies and gents, thank you for joining me and watching me live. I have been Tony, the head financial analyst of FinancialJuice, and also MACROACE as well. Again, thank you very much. I will see you guys tomorrow. Take care.